The Treasury attempted to stop this, and it didn't work. They had the tools. They had the trillions. They had every lever a government is supposed to have. And still, gold crossed $4,600, right in front of them, somewhere between a war that didn't move the price and a bond market that stopped listening. Something broke, not loudly, not with a headline, but quietly enough that only a handful of people even noticed it happening. And by the time they did, it was already too late to stop. What you're about to see is not a prediction. It already happened. The only question left is whether you're one of the people who saw it in time. Before we go any further, welcome to Next Alert. If you're the kind of person who likes to understand what's really happening with your money before it shows up on the evening news, you're exactly who this channel was built for. Now, I want to ask you for something. Not a favor for us, a favor for yourself. Think of that subscribe button the way you'd think of setting an alarm clock. You don't set an alarm because you like the sound of it ringing. You set it so you're not the last one to wake up. That's all subscribing here does. To make sure you're not the last one to find out. So go ahead, tap it. It costs you nothing, and it takes less time than pouring a cup of tea. And while you're at it, tell us one thing in the comments. Where are you watching this from today? We'd genuinely like to know who's sitting on the other side of this screen with us. Now, let's get into it. On a quiet Wednesday morning, with no fanfare and no press conference, the United States Treasury made a decision that would tell the world more about the state of American finances than any speech ever could. It announced it would at least double its buyback of 10-year and 30-year government bonds. On paper, it read like routine debt management. In practice, it was something else entirely. A government stepping in to buy its own debt back from the market, in size, and without much warning. The market noticed immediately. Long-term bonds rallied within hours. For a moment, it looked as though the maneuver had worked exactly as intended, but by Thursday, something strange had happened. The rally had evaporated. The 10-year yield, the number that quietly sets the price of mortgages, business loans, and government borrowing itself, finished the week higher than before the announcement had even been made. The intervention had not failed loudly. It had failed quietly, which is often the more dangerous kind of failure. To understand why this mattered, it helps to understand the number sitting behind it. On the very same week, U.S. Treasury data confirmed that the national debt had crossed $40 trillion for the first time in history. Not 40 trillion as a projection. 40 trillion as a fact, already on the books, already accruing interest. For decades, the American government had operated on a simple, almost sacred promise to its lenders. Borrowing would be regular, predictable, and free of surprises. That promise was not incidental. It was the very reason the rest of the world had been willing to lend to America more cheaply than to almost anyone else on Earth. The double buyback broke that pattern. It was not regular. It was not scheduled months in advance. It was reactive, and everyone paying attention understood exactly what that meant. A government does not intervene in its own bond market because conditions are comfortable. It intervenes because the cost of not intervening has become harder to bear than the cost of admitting there's a problem. The Treasury Secretary, for his part, offered no apology and no retreat. Asked about the failed rally, he dismissed the entire episode as noise within a 24-hour window, insisting the buybacks could grow even larger than initially planned and that a broader fiscal plan was still to come. He was not defending the move. He was defending the timeline, which is a very different thing. What the market seemed to understand and what the Treasury seemed reluctant to say out loud was simple. The government had reached for one of the most powerful tools available to it, buying its own debt, and the debt had not blinked. For an economy carrying this much weight, that silence was not comforting. It was the first sign that the old rules were no longer holding, and that gold, quietly, was already responding to a signal most people had not yet learned to read. For as long as modern markets have existed, there has been one instinct nobody had to teach. Trouble in the world, gold goes up. It is the oldest reflex in finance, older than most of the institutions, now managing the crisis it was built to hedge against. Investors did not need a textbook to learn it. They absorbed it the way people absorb the fact that fire burns, through repetition, through history, through every crisis that came before. And for decades, the reflex held. Then came the week the United States moved against Iran, and the reflex simply did not fire. Gold fell. Silver fell alongside it. A chartist with 4 decades of experience reading these exact patterns described it plainly. The geopolitical uncertainty that would normally have sent investors racing towards safety instead left them unmoved. War had arrived, and the market had shrugged. This alone would have been notable, but it was not isolated. Days later, the 30-year Treasury yield climbed to levels the market had not witnessed since 2007, a full 18 years earlier. Under the old rules, this should have been gold's enemy. Gold pays no interest. It generates no yield. When government bonds suddenly offer investors more return for holding something safer and more liquid, gold is supposed to lose the argument. Instead, gold rose anyway, moving in the opposite direction, the textbooks had predicted for generations. Two reflexes, broken in the same week, are difficult to dismiss as coincidence. Something underneath the surface had shifted, and the shift had a name few investors were yet using out loud: a quiet, structural erosion of trust in debt itself rather than a response to any single event. The explanation begins with an unlikely competitor. Artificial intelligence companies, in the middle of the most capital-intensive build-out in corporate history, have entered the debt markets in staggering size, seeking the same lenders and the same pool of capital the United States government has relied on for its own borrowing. What was once a market with one dominant borrower, the state, now has two, and both are asking for more than the system has comfortably supplied before. A senior strategist tracking these flows described it as a segue, almost a natural handoff, from corporate debt concerns directly into the case for gold. The reasoning was not emotional, it was structural. When two large borrowers compete for the same limited capital, yields rise regardless of what either side intends, and the cost of servicing existing debt rises with them. This is the mechanism most investors have not yet been taught to watch. It has nothing to do with fear of missiles or geopolitical headlines. It has everything to do with arithmetic. A nation carrying $40 trillion in obligations cannot absorb a meaningful rise in borrowing costs without consequence, and the market appears to understand this even when policymakers have not said so publicly. One senior official effectively conceded the point, describing corporate borrowing as a short-term competition for capital, while offering a more optimistic ending than the alternative interpretation circulating elsewhere. Two people, looking at the exact same set of facts, arrived at two very different conclusions about where it leads. What they agreed on was the underlying force driving it. Gold, in this reading, was never reacting to Iran at all. It was reacting to something slower and considerably harder to reverse: a growing recognition that the promises underpinning sovereign debt are being tested by forces that have nothing to do with war and everything to do with who, exactly, is going to be asked to pay for all of it. The reflex that failed to fire during the conflict was not broken. It had simply moved on to watching something else, something the headlines were not yet built to explain, and something the business community would be wise to start paying very close attention to. There's a question that rarely appears in financial headlines, but sits underneath almost every one of them. When a government intervenes to manage its own debt, who actually pays for the intervention? The answer is never the government itself. It is always someone further down the chain, usually someone with far less capacity to absorb it. By the time the Treasury's buyback maneuver had faded into the background of the news cycle, the consequences had already migrated into the parts of the economy that rarely make it into a market recap. Mortgage rates climbed to levels near a one-year high, settling close to 6.8%. For the ordinary household, this was not an abstract figure on a bond chart. It was the difference between a monthly payment that fit a budget and one that did not. A new home now consumes roughly 34% of a typical family's income, the worst that measurement has been since 2023. The bond market moves in basis points. Housing affordability moves in real decisions about where families can afford to live. Meanwhile, the dollar told its own story. A broad measure of its value slipped to a 3-month low during the very week the Treasury was working to project strength. Here lies the uncomfortable truth few officials say aloud. A government can buy back its own bonds. It can shift who holds the paper, when they hold it, and how the yield curve looks on a given afternoon. What it cannot do is buy back a currency. The obligation itself, the actual $40 trillion owed, does not shrink because of a clever maneuver in the bond market. It simply changes hands quietly, while the underlying weight remains exactly where it was. This is the part of the story that rarely gets explained to the business community in plain terms. Managing appearances and managing reality are two different exercises, and markets eventually learn to tell them apart. The Treasury Secretary himself seemed to acknowledge as much, framing the intervention as fiscal consolidation rather than crisis management, and expressing confidence that bonds would continue to climb once markets understood the strategy. Confidence, however, is not the same as proof, and the yield curve had already offered its own verdict days earlier. At almost the same moment, an entirely different market was quietly telling a parallel version of the same story. Copper, historically one of the most globally distributed commodities on Earth, had begun stacking up inside American warehouses at a pace nobody in the industry had witnessed before. Close to 70% of all exchange-held copper across the world's 3 major futures markets was now sitting inside the United States, a country that consumes only a fraction of that share globally. The metal had arrived ahead of a tariff that had not even been written yet, positioned defensively by traders anticipating a policy shift before it existed. Once inside, it largely stayed inside, becoming something close to a stranded asset, unable to flow back out to the rest of the world that still needed it. Two very different markets, bonds and copper, were displaying the same underlying behavior, Capital and materials were repositioning themselves not in response to what governments had done, but in anticipation of what governments might be forced to do next. This is the signature of a system under strain rather than a system in crisis. Nothing had collapsed, but movement itself, quiet, defensive, and increasingly self-protective, had become the dominant behavior across markets that rarely move in tandem. For anyone building a business, managing capital, or planning years ahead rather than months, this is the detail worth sitting with. Intervention can redirect where money flows for a while. It cannot manufacture housing affordability, restore falling currency, or unstrand a metal that has already moved. It can only buy time, and time in an economy carrying this much debt has never been free. Every story of intervention eventually arrives at the same unanswered question. What happens when the tools run out and the timeline the officials keep promising finally comes due? By the final days of the week, that question had a very specific address: Jackson Hole, Wyoming, the last Friday of the month, where the newly appointed Federal Reserve Chairman would deliver his first keynote address as the man now responsible for making sense of everything that had just occurred. The setting matters more than it appears to. Months earlier, at his first press conference, the incoming chairman had said something that drew almost no attention at the time. He noted that market participants were learning to price in the underlying data itself, rather than waiting for the Fed to signal a direction first. Prices, in his words, would move wherever the market decided they belonged. It was a quiet admission that the Fed's usual authority, its ability to guide expectations before the market moves on its own, was weakening. 6 weeks later, the Treasury began buying its own long-term bonds. If the Federal Reserve is meant to take its signal from the market, and the Treasury is now actively managing that same market, an uncomfortable question follows the new chairman onto the stage. What precisely is left for him to read that has not already been shaped by someone else's hand? He inherits a Federal Reserve that is far from unified. The most recent vote to hold interest rates passed 9-3, with several officials pushing for a hike that did not happen. Since that vote, retail sales have fallen at the sharpest pace in over a year, while core inflation has come in softer than expected. An economy visibly losing momentum, a committee openly divided on what to do about it, and a Treasury Secretary quietly reshaping the very bond market the Fed is supposed to be reading independently. This is the environment the new chairman steps into, not as a bystander, but as the person now expected to explain it publicly for the first time. The oil question sharpens the stakes further. The Treasury Secretary has staked much of his optimistic outlook on the idea that current inflation pressure is driven almost entirely by energy prices, and that this pressure is temporary. If crude oil continues climbing rather than falling, that argument collapses, and the case against raising interest rates loses its foundation. Brent crude finished the prior week above $93, up roughly 2% in a single session. Should this pressure hold into the chairman's Jackson Hole address, he will not be discussing a temporary energy spike. He will be facing an inflation source no one can credibly describe as short-term any longer. Layered on top of this sits the corporate earnings calendar, with a major technology company's results due out around the same window, offering what may be the clearest available signal on whether the artificial intelligence borrowing boom, the same force quietly competing with the government for capital, remains on schedule or begins to slow. A slowdown there would ease pressure on yields. An acceleration would tighten it further, adding weight to an already strained system. One market strategist offered the sharpest framing of the entire situation, almost in passing, without pausing to underline its importance. Copper, he said, is a shortage of materials. Gold is a shortage of trust. Within the same week, both had visibly worsened. Materials can eventually be mined, shipped, and resupplied, however slowly. Trust, once it begins eroding at the level of sovereign debt, does not restock itself on a predictable timeline. For the business community watching from the outside, the lesson is not a prediction about where gold, yields, or the dollar will sit next month. It is a recognition that the old signals, war, geopolitical tension, headline interest rate moves, no longer explain what markets are actually pricing in. Something quieter is now setting the terms, and on a stage in Wyoming, a new chairman is about to discover exactly how much control over it he still has left.